How has the pandemic continued to reshape commercial real estate markets across North America, and what does this mean for future developments? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. In a recent report by JLL, the ongoing impact of the pandemic on Pittsburgh's commercial real estate market has been analyzed in depth. The report highlights a continued shift in market dynamics, with notable changes in office space demand, tenant leasing, and industrial developments. It's evident that the effects of the pandemic are still being felt, influencing how businesses and investors approach real estate opportunities. The report suggests that the demand for office space in Pittsburgh has evolved, with more businesses reassessing their space needs. This trend is not unique to Pittsburgh, as we see similar patterns in regions like Kitchener-Waterloo and London, Ontario, where companies are increasingly adopting hybrid work models. This shift is prompting a reevaluation of office space utilization, leading to a potential decrease in demand for traditional office environments. On the industrial front, the report indicates that there is a growing interest in logistics and warehousing spaces, driven by the surge in e-commerce and supply chain adjustments. This mirrors the situation in Cambridge, Ontario, where industrial developments are on the rise to accommodate the increasing demand for distribution centers and manufacturing facilities. Retail spaces are also undergoing transformation, with a focus on repurposing existing properties to meet new consumer behaviors. The trend of converting retail centers into mixed-use developments, such as incorporating residential units, is gaining traction in both Pittsburgh and Canadian cities. This approach not only optimizes space, but also addresses the need for more housing options in urban areas. JLL's report provides a comprehensive view of the current state of Pittsburgh's commercial real estate market, offering valuable insights for investors and stakeholders. As we continue to navigate the post-pandemic landscape, these findings underscore the importance of adaptability and strategic planning in real estate investments. Real estate professionals in both Canada and the United States are observing potential shifts in federal office locations following a recent directive. The new executive order, signed by President Donald Trump, has removed previous rules that mandated federal agencies to prioritize downtown and historic areas for their site selections. This change opens the door for federal offices to consider suburban locations, which could have significant implications for commercial real estate markets. The General Services Administration, responsible for managing the federal government's civilian real estate, is now tasked with reducing its property inventory. This involves identifying excess or underutilized buildings that could be sold or repurposed. The U.S. Department of Housing and Urban Development's headquarters in Washington, D.C., is among the properties listed for potential accelerated disposition. This directive is seen as a move towards cost-effectiveness, allowing federal buildings to be situated in areas that better suit their operational missions. The flexibility in site selection could lead to increased demand for suburban office spaces, which often offer advantages like free parking. However, commercial real estate executives, such as Darian LeBlanc from Cushman & Wakefield, suggest that these changes may not result in widespread relocations of federal offices. In Canada, similar trends could influence how government and corporate offices are distributed, particularly in regions like Kitchener-Waterloo and London, Ontario. These areas might see a rise in suburban office developments, mirroring the potential shifts observed in the United States. This could provide opportunities for real estate investors and developers looking to capitalize on changing office space demands. The broader implications of this executive order could also affect urban development. Historically, federal offices have contributed to economic growth in downtown areas, as seen with the Bureau of Alcohol, Tobacco, Firearms, and Explosives headquarters in Washington, D.C., which revitalized the NOMA district. As federal agencies explore relocations, regions are competing to attract these offices, with officials from Ohio and Texas actively lobbying for relocations to their districts. As we continue to monitor these developments, it's crucial for stakeholders in the commercial real estate sector to stay informed and adapt their strategies accordingly. The changing landscape of federal office locations could present new opportunities and challenges for both Canadian and American markets. In a noteworthy development in Boca Raton, Florida, Selig Enterprises is set to transform a retail center into a multifamily residential complex. This project involves the construction of a 341-unit apartment complex at 1401 West Palmetto Park Road. The initiative also includes plans to expand and enhance the existing public supermarket at the location. According to the South Florida Business Journal, this redevelopment will occur without any zoning changes due to the utilization of the state's Live Local Act. This act allows developers to bypass local zoning regulations if a portion of the units is designated as workforce housing. The Live Local Act specifies that 40% of the apartment units must be allocated as workforce housing, catering to individuals earning up to 120% of the area median income. The existing Palmetto Park Square, constructed in 1982, currently spans 196,200 square feet of retail space, which includes a 28,000 square foot Publix. Selig Enterprises has held ownership of this property since its inception in 1982. Notably, a nearly 100,000 square foot Kmart within the center was closed in 2019. The redevelopment will proceed in 2 phases, with an estimated completion timeline of about 3 years. This transformation reflects a broader trend of repurposing retail spaces into mixed-use developments, a strategy gaining traction in both the United States and Canada. In regions like Kitchener-Waterloo and London, Ontario, similar projects are underway to address housing shortages and adapt to evolving consumer behaviors. By integrating residential units into existing retail spaces, developers are optimizing land use while meeting community needs for more housing options. This project in Boca Raton underscores the ongoing shift in real estate strategies, emphasizing flexibility and innovation. As more retail centers are repurposed to include residential components, the commercial real estate landscape is adapting to new market demands. Investors and stakeholders should take note of these changes, as they present both challenges and opportunities in the multifamily and retail sectors. In Lake County, Florida, a significant land acquisition is setting the stage for an expansive industrial development. SDP Camp. Lake LLC has purchased a portion of a 163-acre parcel at the northwest corner of Hancock Road and the Florida Turnpike in Mineola for $21.1 million from Scorman Development. This transaction, finalized on April 11th, signifies a pivotal step towards the construction of a massive industrial facility in this burgeoning residential market. The purchaser, linked to Atlanta-based Strategic Real Estate Partners, plans to develop a 1.36 million square foot industrial building within the Camp Lake Commerce Center. This facility will feature a 971-space parking lot, underscoring the scale of the project. Notably, Scorman Development had acquired the property in 2021 as part of a broader $29 million deal, which included land across the Florida Turnpike in the Hills of Mineola community. The Hills of Mineola is transforming into a dynamic mixed-use development, with plans for thousands of new homes, retail spaces, and amenities. The Polta Group is actively constructing 846 single-family houses on a 69-acre segment of the community. Additionally, a 50-acre parcel is earmarked for a town center featuring a hotel, big box retail, restaurants, and a Publix supermarket. The development also includes a new food hall and headquarters for Crooked Can Brewery. From a logistics perspective, the Mineola site is strategically positioned with direct access to major transportation routes like the Florida Turnpike and U.S. Highway 27, making it ideal for industrial activities. According to a first-quarter report from CBRE, Lake County has a 12.8 million square foot industrial inventory with a vacancy rate of 15.3% and an average asking rate of $6.73 per square foot. This development in Mineola highlights the growing trend of integrating industrial projects within residential communities, a pattern observed in both the United States and Canada. In regions like Kitchener-Waterloo and London, Ontario, similar industrial expansions are underway, aligning with increased demand for logistics and warehousing facilities. This cross-border relevance underscores the importance of strategic location and infrastructure in supporting industrial growth. In a significant transaction within the Atlanta commercial real estate market, the North Creek Office Park in Buckhead has been sold for nearly $78 million. This sale highlights a trend of value resets within the office property sector, presenting potential opportunities for investors seeking bargains, even in upscale areas. The 40-acre office park, located near the prestigious West Paces Ferry Road, was acquired by a joint venture between Athens-based Landmark Properties and Westlake Capital, the family office of Landmark's chairman. The purchase was made at a discount compared to its previous sale price of over $101 million in 2016 as per property records. Landmark Properties, primarily known for its student housing developments, seized the opportunity to purchase the North Creek Office Park to accommodate its expanding workforce in Atlanta. Landmark's chairman and chief executive officer Wes Rogers emphasized the strategic move to buy when office occupancies and property values are low, indicating the potential for significant returns on investment. The joint venture plans to revitalize the common areas of North Creek to enhance the tenant experience, supported by a $68.5 million loan from Acor Capital Mortgage Limited Partnership. The office park comprises nearly 537,000 square feet of office space and extensive surface parking areas, with more than 70% occupancy, as reported by JLL, the firm that marketed the property. While Landmark Properties is not typically involved in the office sector, the acquisition aligns with its broader strategy to diversify its portfolio and leverage market conditions. The company's growth trajectory is evident, with over $15 billion in assets and a $10 billion pipeline of student and multifamily projects. This transaction underscores the importance of strategic investment decisions in the commercial real estate sector, where value resets and basis collapses can present lucrative opportunities. As Zach Gruber, principal and president of the office division at Banyan Street Capital, noted during a panel discussion, investors must carefully assess the attributes of individual properties to capitalize on these market dynamics. As we continue to observe these trends, it's clear that adaptability and strategic foresight are crucial for success in the evolving commercial real estate landscape. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.